As an ADF member or a veteran, if you're in the property market right now, and for instance, if you're living in your own home, you're stuck what's called in the 30-year mortgage trap. I want to show you an awesome little case study here, which is like a really, really simple way to get out of that. It's literally going to save you years and years off your loan and bring down your repayments by hundreds of thousands of dollars as well. Don't go anywhere, give me 90 seconds. So if you're living in your own home right now, the average home loan in Australia is about $400,000. And if it's say it's going to take you 30 years to pay off that home loan on an average of 4.5%, I know interest rates are down at like 1.5%, 2%, but it ain't going to stay like that forever. So let's like average it out a little bit. Did you know it's going to cost you $729,000? Listen to me carefully, $729,000 to get to the end of 30 years, and I'm going to give you a little golf clap and go, well done, Diggy, you've just paid off your own home, but all your money's in your house. This is not Dilly or TK where you can knock some bricks out of the side of your house, take them down the flea market, come back, feed your family for a week. You've got no choice but to be concurrently investing and create a passive income or pay your home off a lot quicker so you can do something else with your money while you're still working. This is how it works. If you've got some equity in your own home and you're not using it, it's called lazy equity. You can use that equity to go and buy your first investment property. Now that first investment property is going to be in the #1 place in Australia that's going to give you sustained and low risk capital growth. It's going to have a rent return and a tax return, effectively a self-licking ice cream, set and forget, happy days. Fast forward about 3 years when you're buying the right locations, there'll be some equity available in that property as well, and you can basically repeat the process. So now you've got your own home and 2 investment properties that are all located in really awesome places. Doesn't matter where you're living, because that's a lifestyle choice, not a wealth creation choice. But these 2 investment properties are located in premium areas and they've got really good rent return, tax returns. So they're not hurting your hip pocket at all. Fast forward, say 10 years. And then those properties are going to go up in value, and then there's going to be about $150,000 of equity in each of them. It's because here's the thing. What do we got now? You got equity in your own home, you go and buy your first property. 3 years later, you buy another one, and then you hold on that for 10 years. So in 13 years' time, your $400,000 loan is still, you've got about a $300,000 balance because you pay so much interest off in the first 7 or 8 years, and then you start to pay off the principal thereafter. So these 2 properties only have to go up in value about 3.5% of compound growth until they get to a point where there's $300,000 there. You can rework the finances and basically go and pay your own home off in 1 day. Now that, ladies and gentlemen, is how you escape the 30-year mortgage trap. But look at what the numbers say. Now your new cost is only $529, and it's going to happen in 13 years, not 30 years. So you've saved $200,000 and 17 years off your mortgage. As ADF members and veterans, that's what you guys deserve. Don't get yourself stuck in the 30-year mortgage trap, but it starts with using your equity back here. Put a plan, put a strategy in place, work with a group that knows what they're doing, and you will be successful.